up, YouTube? It's your boy Charles Enoch. Y'all already know what it is, so we just gonna get straight into it. So today will be part 2 of how to pay your mortgage with a credit card. Now, in part 1, we learned what credit cards you should use and how to structure that credit card in regards to the due date, statement date, and how to use Plastiq to make your payment. So basically the mechanics on how to structure your finances when using Velocity Banking for this method. Now in part 2, we're gonna go over the benefits on why we will use the bank's money, AKA our credit card, to pay our mortgage and increase our cash flow and delay the payment and push it out for a month. Before we get into it though, I wanna go over a few things so people can get the understanding why we would even use this method. But I'm gonna need y'all to do me a big favor now. If you haven't done so yet, go ahead, smash the like button for me, cause y'all been slacking. So go ahead, make that thing turn blue. Also, if you're new to the channel or just simply haven't subscribed yet, go ahead, take that little bitty time, man. Hit the subscribe button for a brother. I really do appreciate the people that take that quick second to do both. All right, so first things first, we need to understand the difference between defensive investing and offensive investing. So defensive investing would be paying down your debts. Now that's credit cards, car loans, student loans, mortgages, etc. Anything that you basically owe somebody. So with defensive investing, you're guaranteed a return. For example, if you have a $10,000 balance on your credit card and they're charging you 15% interest and you pay that credit card off within a year, you got a 15% return. So we need to understand most people love something that's guaranteed. That's why this is the preferred method of investing for majority of people. Now, offensive investing is when you put your cash flow into something that could potentially make you money. This would be something like stocks, bonds, real estate, Bitcoin, and even your education. Now, since this is not guaranteed, we may not see a lot of people doing offensive investing. So with a lot of people not really doing it, I would say probably a lot of people wouldn't understand offensive investing, right? And when somebody teaches them this method, they may think it's not smart to use it. And with that being said, this video is about offensive investing and not defensive investing. I'm not showing you how to pay off your mortgage quickly. I'm showing you how to increase your cash flow so you can invest in something else that could potentially make you money. So the last point I'm going to make before we get to the whiteboard, we need to understand what opportunity costs are. So opportunity cost is when you have the potential to gain from other alternative methods. So while opportunity cost is a risk, we need to acknowledge that majority of wealthy people use offensive investing and opportunity costs to build their wealth. So this is something to think about when you see this scenario and you think it doesn't make sense or this is unrealistic or whatever the case may be. All right, now that we got that out the way, let's head to this whiteboard. Let's learn part 2 of how to pay your mortgage with a credit card. Let's go. All right, so we at the whiteboard. We're gonna get straight into it. This is the same breakdown as of part 1. So if you haven't seen part 1, go ahead, pause this video, go to part 1. I'll have it down below in the link and get caught up to speed. All right, so we have the power couple, Shannon and Sean. The income that they get together per month is $12,500. Their expenses are $7,500. Cash flow, the leftover money from the income and expenses, is $5,000. Their line of credit that they have is $25,000. Their mortgage is $4,000, and that's rolled into the expenses. Now they do have a savings account of $50,000, and as on part 1, they have a savings account through Citi, which they have a special offer. When you have $50,000 in a savings account, they're going to give you 0.50% interest or return on your money there per the year. Now, as on part 1, they're going to be using Plastiq, which as of right now, they're charging 2.85% fee. So if the mortgage is $4,000, 2.85% of that is $114 that they would charge extra for the mortgage for using your card. Now the Citi Double Cash card, since they have that special offer, it's going to give them 2.5% cash back. So the 2.5% cash back on $4,000 we see is going to be $100. Now, since they have $50,000 in their savings account and they're going to get $250 in interest for just leaving it there for the year, it equates to $20.83 per month. So if we add $20.83 plus the cash back of $100, that's $120.83. That is offsetting the plastique fee. Now, how we have it structured, we want our credit card, the due date to be the 1st, statement date 3rd through the 5th. Now we're going to go into an example of why we would pay our mortgage with our credit card and use the offensive investing strategy here. So I'm just going to give a scenario here on what potentially could happen here. So we have Shannon and Sean, and let's say that they know another power couple, and the power couple says, hey, we have a rental property and it's $91,000. We got it in the Midwest and we want to go on a deal with you. We need 20% down. We got our half. Do you have your half? So $91,000, 20% of that is about $9,000 some odd dollars. Now it is January 1st. So none of this income has dropped and they are asking them they need the money now. They need the money in a couple days. They can't wait until the end of the month until you get your cash flow and all that stuff. So what Shannon and Sean are going to do, because they like the deal, they're going to use their line of credit and they're going to draw out of their line of credit. You remember they have $25,000. They're going to use the bank's money so they can go in on this deal instantly, January 1st, because again, this is an opportunity and they cannot wait until they save enough money, 2 months worth of $5,000 to get on it. They need to get on it now. So what we're going to do on this scenario, we're going to say that the couple needs to come up with $9,120. And that would be 10%. The other couple will bring their 10% so they can get the rental property. So right now they're out $9,120 on their line of credit. They used it instantly. They used the bank's money. So let's see how that gets broken down in regards to us paying the mortgage with our credit card and using that opportunity cost. All right. So I'm not going to be going into the financial structure breakdown because that was in part 1. But we're on the other side of the board. January 1st, we had to use money off of our line of credit. Now we're going to be following this order of things as of part 1. And we're going to get down to this part right here. So if we follow part 1, we're going to have $9,120.83 in our account. And just briefly how we did that here. So our cash flow is $5,000 that we get every single month. Since we used our credit card to pay the mortgage, that frees up $4,000. So that's where we get the $9,000. We would have to add the cash back that we get, the $100 and the $20.83 that we get for just having $50,000 into a savings account. So this is how we're getting that $9,120.83. So what we do after the end of the month, we're going to transfer $9,120 into our line of credit. What that is going to do, that is going to fill back up our line of credit, right? So we have to think in January 1st, what happened? There was an opportunity to get a rental property with somebody that wanted us to team up with them. Now, since we did that, we had to use the bank's money to get on the opportunity right then and there, because we could not wait 2 months saving $5,000 each because the deal was probably going to be gone. So we used the bank's money. Now, what happened was we used the bank's money further by using our credit card to pay the mortgage, which freed up more cash flow than the $5,000. It freed up $9,000. And we got some cash back and some interest to have extra cash flow. Once we got that cash flow, we dumped it into the line of credit and it filled it back up. All right, so now we're on the month of February. So February, we're going to be following these same steps. Remember, there's no payment for February because the card that we got, the statement date, how it was set up, is going to push it back. See part 1 if you don't understand what I'm talking about. But we're going to go all the way down here. We're going to have that $9,120.83 again of cash flow, because our cash flow is $5,000 and then we paid it on the mortgage. That's $9,000. Now we're going to have to use, before the first comes of March, because that's the due date, we're going to have to use $4,114 to pay off the credit card statement. Because when we use it in January, there's no payment for February, but there is a payment for March, and it's due March 1st. So what we're going to do, let's say it's February 27th, a couple days before March 1st. You want to get that payment in before the 1st, right? So once we do that, we're going to be left with $5,006. Now let's say, and I know that all these events are going month by month and it doesn't happen like that, but these are examples of opportunity costs, right? So let's say that the stock market crashes, or it's an opportune time to get on Bitcoin, or whatever the case may be. Now we have $5,006 left in our account because we had to pay $4,114 from the $9,120. Now this is a really good opportunity, and yes, $5,000 is good to put in stocks, but we want to put in more. This is a really good opportunity because the stock market crash, it's very low, and we think that we're going to get a major return. So what we're going to do, we're going to use $4,114 from the line of credit, from our line of credit, that $25,000, since we filled it up last month. We're going to combine that with the $5,006 that we have in our account. So if you add both of those up, that's $9,120 that we will put into the stock market, into Bitcoin, into whatever you think is a great opportunity. So we have invested, we used the bank's money from the line of credit yet again, and we totaled it to the $9,120, and we invested all that into the stock market because it crashed. Now the stock market, we know, goes up, down, and you have to get on it. There ain't no waiting on this stuff. So this is a very good opportunity for you to use the bank's money, put that in there, and let it grow. All right, so now we're on the month of March. We got a house, and let's say the house is giving us, I don't know, $200 cash flow extra a month, or we can even say $100. Whatever the case is giving you extra cash flow. We're looking at our stocks, and they're going up, and we think that they're going to continue to go up because we bought it at a low price, right? All right, so month of March, we're following these same steps, the same process, right? So if we follow these same steps, we're going to end up with $9,120.83 yet again for cash flow, because we keep on pushing out the mortgage payment every single month. So remember, cash flow is $5,000 that they normally get. Since we're pushing the mortgage out, that's going to add an extra $4,000. We get our little cash back, and we get the interest on our savings account. So that's how we're getting it. So remember that. Now we have to use $4,114 to pay off the credit card statement, because we're using our credit card to pay the mortgage. So before the end of April, before the 1st of April, we need to pay that. So March 30th or whatever, 29th, we have to pay it. So once we pay that off, we're going to end with about $5,006, right? We still have to pay our line of credit back. Remember that we borrowed $4,114. So out of this money, we're going to transfer $4,114 to our line of credit to fill it back up to full. So what basically happened, we had a cash flow of $9,120.83. We have to pay our credit card statement before the 1st of April. So let's say March 28th, we have to use this money to pay that. And then we wanted to pay our line of credit as well too, and fill that back up because we want to pay the money. We want to pay the bank back. So we used another $4,114 out of that $9,120.83. So once we did that, we satisfied the credit card statement. The line of credit is full and our account balance is $892.83. So we got to remember the two opportunities that we got a lot of stock that's going to continue to grow. And then we got a rental property that's giving us $100, $200 cash flow. All right. So now we're on the month of April. We're still going to be following the same steps as part one. We're going to get all the way down. Now, the balance that we have is $10,013.66. Why is it different? Remember, we have a balance of $892.83. If we add that onto the $9,120.83 that we get every single month for cash flow, that's how we're getting that. So once we do that, we know that we have to pay the statement off before the 1st of May. So April 30th, right? We're going to pay the $4,114 to pay off the statement. And we're going to continue to do this method just in case another opportunity comes. If another opportunity comes to get a rental property, get some stocks, whatever the case is, we're going to draw out of our line of credit because we got $25K, use that, and then from the delay, since we delay our payment, we can use our cash flow to be paying that line of credit back. So we're constantly borrowing from the bank because we never know when an opportunity is going to arise and we need to jump on it. So again, this is a method to show you how to prolong the payment, delay the payment so you can increase your cash flow for opportunities. Now, again, if you're not a person that offensively invests or likes the concept of opportunity costs, you probably don't want to do this. This probably would not make sense to you. If you on the 1st in January, if I came up with that scenario of, hey, I got a partner that wanted to invest with me. If you don't have no partners to invest with, this probably isn't going to be realistic or does not make sense. But for the people that like opportune costs and offensively investing and they have groups of friends that do this, this makes perfect sense, right? So if you have a group that's in the stocks and all this stuff, and you guys study this and the market's down and you guys are like, hey, let's do this, let's go in, you have the opportune cost to do so. But if you don't do stocks and stuff like that, this may not make sense. You're more defensive investing. So you just have to think, if you're a defensive investor, that's totally fine, but learn the concept of offensive investing. Don't say that it just doesn't make sense or the scenarios don't make sense or anything like that. Even with, I guess, the income, the cash flow, at one point in time, I thought $5,000 of cash flow is crazy. It's unrealistic. It's ridiculous. But we have to know that there are people that have this type of money or whatnot, or have this type of cash flow. And I do try to accommodate everybody here. So I wouldn't be so hung up on the amount of money or the cash flow. You need to be hung up with the concept of opportune cost and what we are doing in the methodology of it. So once you do that and adjust it to your income or your funds or whatnot, it will be more realistic. So hopefully this did help. Remember, if you guys have not smashed that like button, go ahead and do so, man. Help a brother out. Smash that like button. If you have not subscribed, go ahead, take a little time, hit that subscribe button. I do have a Patreon as well. So if you do like the content, go ahead, support a brother. And like always, man, you guys have a good weekend. Peace out.